I'm Peter White. Welcome to the Inside Network. Welcome to INDepth. I'm Peter White, and my guest today is Mark Williams from Australian Ethical Investments. Mark, welcome.
Thank you, Peter.
Can we start off by looking at the Australian Ethical Charter? What role does that play in your investment process, and can you talk us through it?
Well, very important role. And it's interesting, the Charter's actually been in place since 1986, so over 35 years. And another interesting fact, it hasn't changed over that time.
It must have been cutting edge at those days, wasn't it?
I think so. I mean, certainly ahead of its time in a lot of regards. And so I think, yes, it's fascinating to see over the period of time how much ethical investing has evolved, and we've been doing it as an organisation now for over 3 decades. So I think that gives us a lot of credibility in the market.
What's the nub of the charter, if you can drill it down into it?
It's 23 principles. So we have 12 positive, 11 negative screens, if you like, and things that we want to invest in and things that we don't want to invest in. And so it's really a values-based sort of principles and set of investing tools that we hope can deliver performance, financial performance for our investors, but also positive outcomes for environment and society as well.
It's amazing that it hasn't changed, given how much the world's changed, that there hasn't been any change to the Charter.
No, that's right. We have a dedicated ethics research team that is constantly evaluating it for its appropriateness and its value in the world today. So, there's constant frameworks that they're looking at, reviewing, adjusting, but the fundamental principles have remained the same. And I think that's a testament to the founders back in the day that they had such foresight around a number of these key issues.
Now, one of your responsibilities are SMAs, or separately managed accounts. Can you explain the process of ethical investing overlapping with SMAs and how it affects the way you do business?
Yeah, I mean, I think the SMA structure is a great one for investors and advisors. It's different to the pooled funds environment. We have obviously a number of those funds at Australian Ethical already, but I think the key thing for the SMA structure is it provides transparency. The end investor holds the underlying stocks, again, different to the pooled environment. Secondly, I think the platforms offer the ability for investors to pick and choose a little bit. So our portfolio, if an investor has a particular issue with one particular stock, they can actually replace that with another stock and put it in the portfolio there. So it gives some flexibility in terms of managing that as well. And then lastly, I think it's great for the advisors to be able to use this different type of structure to provide ethical advice to their clients at the end of the day. And they can use this portfolio either as a standalone portfolio, which we think it's obviously a good one, but also as a sleeve in a broader investment portfolio, which provides diversification for the investor.
Where is the industry on the SMA journey? Has it matured? Is it a growth area for your business and for the sector generally? Or
yes, certainly a growth area. So we started the SMA ourselves a couple of years ago, and I think SMAs as a structure, certainly have been growing. They're certainly nowhere near at the size of pooled funds at the moment, but we see a lot of growth in there. I think those key things like transparency, really are attractive to investors and some advisors in the market.
And does the demand come from investor inquiry, or does it come from the advisors pointing their clients in this particular direction for their own benefit?
I think a lot of the demand really has come from the individual investor wanting solutions in the ethical investing space. So I think that was a lot of the primary driver, particularly if you go back a couple of years. Now I think advisors certainly have skilled up in those areas, and they're looking to provide some solutions proactively now to their clients as well. So I think we're starting to see a good mix of both sort of demand from the end investor, but also from advisors that are keen to look at some of these solutions and put them in front of clients.
You've had an interesting career journey in your time in the industry. You've been on the buy side, you've been on the sell side, now you're in ethical investing, and can you talk us through the journey and the trip you've had?
Yeah, well, I guess for me, I started on the sell side, and so I was a transport research analyst, equities research analyst, and probably the first taste I got of ESG investing was I think we were one of the first investment houses to hire an ESG research analyst, and so as part of that, we then tried to write a few reports in our specific sectors around companies taking into consideration some of those ESG factors. And so I wrote a report on Qantas back in the day. That must have been about 10 years ago, I reckon now. And so it was sort of one of the first of these types of reports that I think came out in the market. So it opened my eyes to other areas of the market, not just the pure sort of financial returns. And so that was interesting. And then when the opportunity to join Australian Ethical came around about 6 years ago for me, so I was aware of it, but certainly not as knowledgeable about ethical investing as I am now, but certainly piqued the interest. And then I think what was most interesting to me about Australian Ethical at the time of making that decision was looking at a fund manager that was very purpose-driven on the ethics side, but also was very strong on the performance side of things. And so that was really an attractive combination to me. And so I was keen to join Australian Ethical then, and very proud that we've been able to keep that performance going over the last 6 years.
Did you, in your early days in the industry, did you ever envisage that ESG would become such an important, indeed mainstream factor in investing?
It's incredible how much it's changed and how quickly. So, I think the honest answer going back 15 years ago when I first started was no, because there just wasn't that much interest in the area. It was very niche, whereas you look at where it's come now and it's very mainstream.
Well, that raises the question, how does a company like Australian Ethical maintain its advantage, either perceived or marketing, given that it has become ESG and quote ethical investing has become so mainstream? Is that a challenge for you guys?
Yeah, I think that's it's testament to the longevity of that document and the charter when it was written. We have an ethics team that reviews and is always testing it, and so it's great to see that it has lasted this length of time. And there are frameworks around different sectors that do get reviewed constantly. But the fact that those key positive and negative screening attributes have stayed the same, I think is a great testament to the founders at the time, and I think really gives us a strength in the market as well. We have done this for over 35 years now. We haven't come to it just recently and seen the light. It's something that has been in place. We only do ethical investing. I think that's one of the key things that gives us credibility and real sort of strength in the market.
Well, it seems like you got it right the first time, given the history of the charter. But in these days, everybody is saying that they're ethical or they're ESG. Must be getting harder for you guys in terms of a competitive advantage or branding to maintain that edge. Do you agree or not?
Certainly there's a lot more competition in the market. You're hard pressed to find a fund manager now that doesn't have, I think, an ESG fund of some description. But I think what makes us different is that we have been doing this for over 35 years and it's the only thing we do. So, I think we're very conscious about keeping that process in place. We have a very different process to most, and our ethics research team, using the ethical charter, effectively sets the investment universe for us. And then it's up to us as the investment team to maximise performance based on that. We're not adding an additional ESG layer at the end of the process to tick the box. It is fundamental to who we are, and we're not going to change it. And I think doubling down on that has been very important for us, and staking and restaking that ground and not giving up on that position, I think is very important.
Well, the performance indeed has been incredibly impressive. Is it going to be harder to keep that performance up, to keep going with that track record?
Yeah, well, I mean, that's obviously the test for us as the investment team to keep doing that. But, I think so. I think we can maintain that. And I think, one of the reasons why is I think a number of the sector exposures that we have are typically some of the growth sectors that you'll see going forward. So healthcare technology, renewables, I think lend themselves to continued growth over a long period of time. So we operate in that type of growthy universe is the way we think about it. The ethical charter sets that sort of broader investment universe. But then for us as an investment team, it's then to maximise performance within that. And I think one of the important things as well is just because a stock comes through our ethical screens doesn't mean we will necessarily own it. So that's where our fundamental bottom-up approach really comes into play as well, to try and pick the winners from that broader universe.
Well, looking forward on the Australian equities market for the next 5 years, are you saying to me that really the sectors you're in now are the sectors that you're going to stay in, more or less?
If you think about the broader market, the ASX 200, almost 50% of the index comprises the broader resources market and the big four banks.
And Telstra.
And Telstra, but it's not a great spot to start from a portfolio diversification perspective. I think the exposures that we offer, when you talk about healthcare, IT and renewables, that's about 45% of our portfolio. And I think that's a much better starting point to think about diversification over time and some of those more attractive sectors that are going to keep growing for the next 5, 10, 20 years.
That sector message, if you like, is it harder to get over to the advisor community or to the end investor, or both, or neither?
I think it's interesting. I think if you go back probably not even 5 years ago, where we were seeing the demand was certainly coming through more from the end investor. They were pushing advisors to learn more about ethical investing, ESG, etc. I think now, certainly there's still that element of it, but advisors, they're also skilling up and they're also seeing the opportunities coming in those types of sectors and opportunities around ethical investing to put forward to their clients as well. So it's certainly come a long way.
I don't want to tell me what stocks you're going to buy, but could maybe we look at some of the stocks that you've got in your portfolios and your SMAs that you like and think have got great futures?
Yeah, sure. Yeah, so I think sticking to those key sectors in the technology space, a couple of stocks that we own there. Link Administration is actually under takeover offer from Dye & Durham at the moment, so it shows how attractive these types of businesses are. We've got Bravura Solutions, but also Nitro Software, smaller stock. It has been derated a bit through the tech sector sell-off over the last couple of months, but we look at that business and we think there's a lot of growth over the next 5 to 10 years. It's a global SaaS business. Its revenues are growing north of 40% per annum at the moment. It's got a well-capitalised balance sheet and it's trading on 4 times EV to sales. And when you compare that to a similar type of business, DocuSign in the US, DocuSign's trading on about 10 times. So that's where we think there are opportunities within a tech sector, particularly in the Australian context, that can really provide good returns over time. And then jumping across to renewables and that sort of broader grid-scale utilities sector, while it's disappointing that we can't find too many opportunities on the ASX itself, we do look to New Zealand for some of that exposure. And so we hold a number of the gentailers over there, Mercury, Meridian and Contact. Contact Energy is probably the one that we're more excited about even than some of the others. From an earnings perspective, last year outperformed its peers there. But when we look forward, it generates good free cash flow. It's got some growth projects coming online. It offers a 4 or 5% dividend yield, and it's cheaper than its peers there as well. So, we think that's going to be a great story going forward as the decarbonisation theme in New Zealand really continues to move ahead. And so we think there'll be more opportunities, and hopefully we see a few more opportunities come to the ASX as well.
What about the elephant in the room, COVID? You've lived through 2 years of investing. What are the lessons learned in that period of investing in a pandemic, and how is that going to inform the way you go forward in terms of your investment choices? Yeah,
it's certainly been an interesting couple of years, a bit of a roller coaster ride. And I think we've seen bear markets and bull markets in that space of time, which is pretty quick. But I think from our perspective, we really focus on the bottom-up fundamental analysis. So we always think there's opportunities in both bull markets and bear markets. I think given the recent sell-off, there's great opportunities showing themselves again in the tech sector where valuations aren't as extreme as they were. So we continue to look for opportunities across those key sectors that we focus on, and I think we'll continue to hopefully find some more.
The health sector particularly is not a one that's flashing green?
No, certainly we think there are opportunities there as well, and some of the stocks we hold in that space, Helios, it's actually at the largest weight in our portfolio, pathology testing, and they've used this COVID sugar hit from, think about all the COVID tests that we've all taken, using some of that cash flow to try and diversify that business. And so trying to position their business more diversified, more stable going forward. Cochlear, we own as well. Everyone will know the hearing implants that Cochlear makes, great global business, and we've been buying some more in that particular name recently as well. So yeah, we think there are good opportunities in a number of different sectors there that continue to grow over time.
Well, Mark, thank you for talking to us today. Fascinating.
Thanks, Peter.